It's hard to know if there's actually one threshold level of bond yields that all of a sudden is going to make investors feel as if that's worthy of pivoting away from stocks into bonds. It's much more of a continuum. But one thing you can say with this lift in bond yields is that, there was a saying for a while that stocks are the new bonds. If you wanted yield, you had to buy stocks and collect dividends. Well, right now, Treasury securities all the way down to 1 month exceed the yield, the dividend yield in the S&P 500. So that story is no longer the case. Bonds are the new bonds. And so the idea that 3.2% for whatever reason on the 10-year yield is going to create a wholesale shift, I don't think makes a lot of sense. It all depends on somebody's expectations for what equity returns might be in the coming 10 years. A lot of models with valuations right where they are say that maybe we're good for mid to high single digit S&P 500 returns, total returns, including dividends. That would probably be maybe an optimistic case. Well, in that case, maybe 3.2% for a safe, income where you're not risking your principal is going to start to look good. I personally don't think this is mainly the reason that higher yields impact stock prices. I think it's leveraged funds that basically have a higher cost of holding positions. That happens first. And then valuations in general get capped out as well as you have corporate bond yields also go up and make debt more expensive. So all this stuff is in the mix. I also think, by the way, guys, if the bond market were open today, very good chance yields would be lower based on what those interest-sensitive sectors of the market are doing.
Mike, the point that bonds are the new bonds is a good one, but at the same time, we're seeing a bid to the sectors that had been typically viewed as bond proxies, namely utilities as well as consumer staple stocks. So what do you think the message of the market is for those sectors, and what is that telling us?
Well, for one thing, you've seen this spike in volatility in the markets. It looks like the market is in a little bit of an unstable position, just short term right now. And so I do think there's still that safety bid. But also, it wouldn't surprise me if it was the stock market's way of handicapping that this phase of this yield move to the upside maybe is close to running its course. So that's why I feel like if the bond market in the U.S. were open today, we might actually see a little bit of a retracement lower in bond yields, and maybe that's waiting for us tomorrow.
Yeah.